In 2022, the Mansa-X Kenya Shilling Fund returned 15.59% net of fees to our investors. The Dollar Fund, which we started in October last year, returned 2.52%, again net of fees for that quarter to our investors. That's an annualized return of about 10% on the Dollar Fund. Last year, the Kenya Shilling Fund for Mansa-X delivered 15.45%. So you can see a slightly better performance last year compared to 2021. For the Dollar Fund, it's a new fund, so there's nothing to compare it with, but we feel that a return of about 10% annualized still beats most of the dollar funds out there in the market. Again, we also saw a significant growth in the AUM numbers last year. If you look at our Kenya Shilling Fund, it grew by 87%. We closed 2021 at an AUM in the Kenya Shilling Fund of 6.6 billion and closed at about 12.3 billion last year. So that's a growth of about 87% for 2023. One of the things that pleases us is that we were able to grow the amount of funds that we manage and still maintain an even better performance for the fund. And we feel that moving forward, this is something that we expect to be consistent for Mansa-X. So 2022 was a very interesting year and one of the most interesting years we've had on record. Although, to be very honest, since the COVID-19 pandemic started, it's always been interesting in terms of new things happening in markets. But last year we had a very interesting year with different quarters having different types of markets. So we started 2022 on a very bullish angle. In fact, the stock market jumped. We had a very serious stock market rally at the beginning of 2022. In fact, you can compare this to the stock market rally we had when Barack Obama started his presidency, where we saw the S&P jump significantly, and some stocks like Tesla, moving up as much as 13.5% within the first week. As the quarter progressed and the year started, we started having significant concerns about inflationary numbers, and this became the overriding theme for the rest of the year. And everything that happened in markets last year can be pinned down to, I guess, two major events: inflationary pressures and geopolitical risks because of the action of Russia in Ukraine, and then concerns about the supply chain constraints that were caused by a resumption, or rather what had been happening in the COVID-19 pandemic, zero tolerance policy in China, and how that impacted the supply chain around the world. So here at Mansa-X, we took advantage of all these events to try and squeeze out returns for our clients. Starting with the geopolitical tensions, this had a significant impact on the prices of commodities. So if you look at what happened when Russia invaded Ukraine in February last year, the first things that were impacted, and that's very natural that happened, was really commodities. So we saw the price of grain, so that's wheat, corn. We saw the prices of these commodities go up, and this was expected. Very significant jump in those prices because there were now concerns about the availability of grain around the world, because Russia and Ukraine are big producers for commodities like wheat. So the Mansa was heavily invested in these commodities. We also saw a spike in the price of crude oil. In fact, last year we saw a spike to the highest levels we've seen in a long time of $130 per barrel in the price of oil. Now that was a significant move, considering we were just slightly under $80 per barrel when this started. So you can see how much of a move that is, and for that to happen within a very short period meant that for anyone trading these asset classes, they were able to really squeeze out a good return from these assets. So commodities also included natural gas. We saw the weaponization, if you may call it, of gas prices in Europe, where Russia would then determine how they would then supply gas to the rest of Europe based on their opinion on the war that had been waged against Ukraine. So we saw that and were able to take advantage in trading these commodities, whether it's riding the wave on the trends that erupted from those price changes, or really just taking advantage of the trend that ensued after that. We also then had a lot of opportunities to take advantage of because of the inflationary numbers and the central bank actions against these inflationary numbers. If you look at last year, the Fed increased interest rates by 425 basis points. That's the highest the Fed has ever raised interest rates in one calendar year in its history. So that's quite significant. But there's a reason for it. The Fed funds rate inflationary target is usually 2%. So you can imagine with inflation last year hitting as much as 9%, the concern for the Federal Reserve was quite high, and that's why they were very aggressive in raising interest rates. So of course this has an impact. The first one being naturally the dollar tends to strengthen against all other currencies. And this again created opportunities within the fund to take advantage of a stronger dollar against most currencies around the world. In fact, if you look at the euro, it hit a 20-year low against the dollar. In fact, hit parity and actually dropped below parity at some point. Same thing with the pound. Same thing with the Japanese yen, lowest levels against the dollar in about 24 years. And we saw this happening across the world, even just back here at home. Our own currency depreciated significantly against the dollar for the same reasons. And this is something that a fund like ours is able to take advantage of. The other thing we saw was now the impact on the stock market of these higher rates in the market. So the first thing that happened is that essentially money is becoming more expensive. So companies that were really benefiting from cheap money are the first ones to take a hit. And typically these tend to be growth stocks. So if you look at even our top 10 holdings, a lot of them tended to be tech stocks, which then took a hit from this. We were holding short positions in companies like Datadog, Seagate, Trade Desk, and others. And most of these companies lost value of about 50% from where they were trading at the beginning of the year. And these again are some positions we were able to take advantage of. So let me take an example of one company like Tesla. So when the year started, Tesla actually jumped about 13% within the first few weeks of trading, but then closed the year 65% lower. All right, that's a very, very clear example of how expensive money started affecting growth stocks, and that was something that was able to be. That was a much easier thing to predict than even which stocks to go long on. Again, looking at on the fixed income side, that's a third thing that's then affected by higher yields naturally. We saw, for example, the US 10-year bonds actually jump up by more than 236 basis points. Now, don't forget that the US 10-year bonds are actually the basis for most of how you price loans across the world. So that meant that on our side, it was a very good play to really short a lot of these long-term bonds in the market, whether it's a US 10s, whether it's a German 10s, and the UK 30s. So you had a lot of short positions that you could take advantage of as these bonds lost value with higher interest rates. So last year, therefore, created many opportunities within the year to take advantage of all these volatility trends, new trends coming out of all these changes in the environment that the fund was able to take advantage of. In fact, the dullest period of last year was really the Q4 period of the year, where we saw a lot of subdued volatility, lower trends, mostly because you had such an overheated year that we could argue that we needed to slow down, which is actually what we saw in Q4. So Q4 was a very much quieter period, and we saw a lot of turns in some of the initial jumps. So for example, in Q4, whereas the dollar actually strengthened for the first 3 quarters of the year, we actually saw the dollar now lose some value in Q4. For precious metals, we can specifically mention gold. Continues to be a laggard for us in the fund. We find that it has failed to really live up to its reputation as a safe haven asset. Mostly because we've had such a good run in the stock market that the price of gold has therefore has been overlooked. If you look at the last 10 years, the S&P 500 has grown by 362%, whereas gold in that same 10-year period has only grown by 16%. But granted, there are periods where gold has outperformed these assets. If you remember, during the COVID era, it was one of our biggest asset classes in Mansa-X, and during that period, it really outperformed. But over a longer period of time, we found the performance of gold to be quite muted. So in Q4, however, we saw gold and silver gain slightly, but we also attribute the gain of these precious metals to really the slight fall in the dollar we saw for Q4, which is what made it a bit, at least close the year slightly higher by just under 5% for 2022. So if you look at our fact sheet, we have a section in the fact sheet where we refer to the top 10 holdings. Now 2022, due to the shift in investment landscape during each quarter, you might have noticed that we had significant changes in some of our top 10 holdings. In fact, I think even if some assets remained in the top 10 holdings, the nature of why they were there changed. For example, crude oil remained one of our top 10 holdings, but in the first half of the year, crude oil was on our top 10 holdings as a long position. But in the second half of the year, crude oil remained as one of our top 10 holdings, but now we were holding a short position. So you can see how sometimes the top 10 holdings, we shift just based on how the investment landscape is changing. One thing that remained constant, however, at least at the beginning of the year, we really had a lot of commodities on our list. So we had crude oil, wheat, and natural gas mostly featuring in our top 10 holdings. Within the top 10 holdings, we also tended to have companies that give us good dividend yields. Such companies include Cigna, AbbVie, those are healthcare companies. We saw them gain between 20 to 40% last year alone, and they also had significant dividend yields of about 3.5%. Dividend yield is important for investors and for ourselves at Mansa-X because it means a company over time will continue to perform better because investors will flock to it if markets become uncertain. And also, investors are more hesitant to sell a stock that gives a good dividend yield. So the same reason that ExxonMobil remains one of our biggest stocks that we own, and featured mostly as our top 10 holdings with a dividend yield of about 3%. And you can see this dividend yield was rewarded by investors with an 80% rise in the price of ExxonMobil last year. Now, as interest rates continue to go up this year, companies that are reliant on cheap money, especially companies that actually do not pay up dividend, mostly tech stocks, took significant beatings. Last year, if you look at 2021, the average dividend yield for the American stock market was about 2%. But now you see we closed last year with the Fed fund rate at 4.5%. So you can see very quickly, if a company is not giving proper dividend yields and like the tech companies, you're actually not even paying any dividends, then you'd have a significant a loss of investor appetite. So I just mentioned a few tech companies. So for example, Tesla, we saw Tesla lose 65% last year. One of our favorite shorts was Snowflake as well. We saw PayPal lose about 62%, one of the stocks we were really short on. CarMax losing about 53%. In Q3 and Q4, we threw in more shorts like Datadog, Seagate, Trade Desk. Some of these are cloud scale application companies. The reason why they would then lose value is one, some of them have never been profitable. For example, AppFolio, they've actually never been profitable. So investors, if you're in an environment where money is getting more expensive, then lack of profitability becomes a very hard sell for investors. Then we saw a loss of value in companies also like Trade Desk, where we were also short. That one lost about 51%. On the fixed income side, when you see we've mentioned fixed income in our top 10 holdings, it doesn't necessarily mean that we hold fixed income only as long positions. Locally, we were invested in Kenyan Treasury bonds. That's how we manage some of our cash holdings. We were also invested in Kenyan Euro bonds. We saw very exciting movements in Euro bonds last year. If you look at the Kenyan Kenyan 24s, that's Euro bonds with the maturity of 2020-24, we saw yields as high as 21%, and then the same yield in paper drops from 21% to 11.5% within a quarter. For any fund manager, that's a very exciting space to take advantage of. If you look at how the US 10-year papers, the German 10s, and the UK 30-year gilts also traded, gave a lot of opportunities for those particular markets who are actually short those bonds. So within our top 10 holdings, when you say fixed income, it encompasses all those assets. So you have all these bonds under that fixed income portfolio. Then the dollar index, for actually the entire 2022, we were actually long the dollar. We expected and we were proven correct that the dollar would strengthen against most currencies. So we saw the dollar strengthen against the euro, strengthen against the pound, strengthen against the yen, and most of these at historic levels. Like I mentioned earlier, the dollar hit in parity with the euro, which then dropped to its 20-year low against the dollar, and for the yen again drop into to a 24-year low against the dollar. So if you look at our top 10 holdings, over time it typically keeps changing just to conform with the changing investment landscape. So it's highly unlikely that you'll have the same top 10 holdings quarter on quarter because of the changes that a portfolio manager has to make to the portfolio to then optimize the return while aligning the fund to the current investment landscape, and that's why it's rarely a similar list of assets in the top 10 holdings. The 2022 was a tough year for stock markets, especially if you look at the Nasdaq, which is a very good index to just get a gauge of how tech companies are performing. It lost 33% of its value last year alone. The S&P 500 lost about 19%, 18.9% to be exact, last year alone. So the performance of those two indices was really the worst performance we've seen since 2008 during the financial crisis. So that's how significantly tough a year it was for stock markets. But again, if you look historically, very, very, very tough years in stock markets tend to be followed by a much more bullish market the next year. The same way we see markets recovered after the tough stock market loss of 2008, we then saw a bull run that lasted from 2009 for more than 10 years. So it's the same thing that gives us a lot of optimism this year. We expect that markets will slowly start gaining from this year and beyond. We still expect that, because there's always a lag factor. What happens is that if you increase interest rates, the impact on markets is not exactly immediate. There are a few months into the impact of those higher interest rates, mostly on company earnings. So we still believe there'll be a bit of pressure on the markets at the beginning of the year, but then we expect a slow recovery in markets moving forward. A couple of reasons for this. One is, of course, that lag factor I just mentioned, that means that company earnings will still be, we don't expect them to be very good at the beginning of the year, but we expect this to change moving forward. The second thing is that when it comes to interest rates, which has really been the most important conversation for the last 1 year, we expect that the Federal Reserve will reduce the rate of hiking of interest rates and slowly conclude its rate hike exercise. If you look after the last rate hike in December, where they now raised the Federal Reserve rate to 4.5%, they also stated that based on that particular time and the data that they had, they expect no more than 75 basis points rate hike moving forward. So that, number one, that's less aggressive, and two, it's more definitive. So markets are able to know and predict what kind of interest rates they expect in the future. So that we expect should also trickle into markets and help us to have a much more bullish 2023 in the markets. So of course some caution will still continue, mostly because of geopolitical tensions. Okay, whatever is happening between Russia and Ukraine has persisted and continues to affect especially commodities. And of course, this will be the biggest pain point for most central banks, because a lot of the inflation that most countries are facing are due to higher commodity prices caused by these geopolitical tensions. So that pressure will continue, and that's one of the key risks for 2023. But something again that might counter that risk is the fact that China recently dropped their zero COVID-19 tolerance policy, meaning that with China opening up, again, you have a much more vibrant global economy, which again might dilute some of the effects of the higher interest rates we saw last year, as well as fears around geopolitical risks. So we believe that moving into 2023, there's still a lot more optimism in the stock markets. We believe bonds should recover, especially the long-term bonds. We feel that yields should come off for most of these bonds, and actually we've seen that just beginning in the year. We've already seen that happening. We expect the inflationary numbers will also start coming off. We've already seen that. The US inflation rate is already down to 6.6. Right, that's significant. That's more than 2% from its peak last year. So we expect that this will continue happening, again easing pressure on interest rates. So that's one of the reasons why we feel that 2022 should be a very exciting year in terms of creating a new trend that's mostly optimistic. Locally, of course, I think the biggest factor that is on everyone's mind and worries everybody is really our debt management and our currency. So when it comes to the debt management, we've seen the new administration been very vocal about reducing government spending, which we feel is a very good step in the right direction. We've also seen the government being very deliberate about ensuring that they will not borrow at higher interest rates. All right, so some of this, we call it forward guidance. When you actually state that as a government we will not accept higher interest rates, you send a signal to markets that in a way also pushes interest rates lower, because investors and fund managers then know that there's a limit to how much they can expect to be paid for their funds that they lend to the government. So we feel that this is a step in the right direction in keeping interest rates lower locally. We've also seen the National Treasury CS actually stating that they will also continue making sure that government spending is high. This has an impact of increasing activity in the economy, which again should really boost the economy. On the currency side, a big part of the reason why the currency weakened against the dollar was also because of the higher yields in the dollar itself. Okay, so with the dollar going from 0.25% in yield to over 4.5%, of course, it was going to strengthen against the shilling. And that's how we saw a big depreciation in the shilling. We expect that there'll still be a bit of pressure on the shilling, mostly because of, we just simply export less. So that should have pressure on the shilling, but the rate of weakness in the shilling will not be as significant as it was last year. We don't expect that to happen. In fact, we expect a bit of a pullback in the value of the dollar against the shilling, or at least a slowdown in the rate of depreciation of the shilling against the dollar. We also really watching interest rates locally. We expect that if the inflationary pressures are falling off a bit due to lower oil prices, for example, and lower price of commodities globally, lower inflation rates locally will also ease the pressure on the CBK to not only maybe stop increasing interest rates, but also maybe over time to actually start easing the interest rates. So it's a much more optimistic year for globally, and as a fund we will adjust our portfolio for our investors to align ourselves with all these expectations and continue to squeeze out a return for our investors. The public has reacted very positively to the introduction of the Mansa-X dollar fund, and we are quite pleased by the kind of reaction we've seen in the market. In October, when we started the fund, we started with around $1 million in assets under management. We closed 2022 with about $4 million in assets under management. That's a fourfold increase in just 3 months. And we think it's because Kenyans, especially those Kenyans in the diaspora, I mean, we have two categories: Kenyans whose income is in dollars, or Kenyans who earn and outside the country, so what we call our diaspora community. We feel that they were really waiting for a product like this, and we are very happy about having a product like this because the diaspora community has always asked us to create something that falls within their needs and allows them to continuously invest back in Kenya in something that's a lot more interesting than your typical traditional asset classes that they used to have accessible to them. So moving forward, even as a country, we feel that if we create more dollar funds that beat the average market return, we feel that you'll have a lot more diaspora remittances, because a lot of these Kenyans in the diaspora still invest in fund managers out there in the West, whether it's in American markets or on the European continent. We still have a lot of diaspora investing in those funds. So if we create something for them locally, we feel that those flows will be reverted back to where they belong, which is really in Kenya. So we're very happy as SIB to continue creating new products like this, products that answer to the needs of the markets, and also products that give Kenyans the comfort that a lot of these products that are available in the West can also be done locally. Which brings me to one of our newest products within SIB. We recently started offering solutions for Kenyans who need trade finance solutions. So it's one of again, a pioneering thing that we are doing at SIB, because really most of this used to be done by commercial banks, but now as SIB we are actually offering trade finance solutions, and we've seen a lot of interest in the market, where, for example, a lot of our clients who do business with the government, or a lot of our clients who import or export products or do international business can now come to us and we offer them trade finance solutions, whether it's contract financing, giving them performance guarantees, LCs. We're able now to create we're able to actually give our clients these products, and we are very excited and hope to see that a lot more excitement from the public about this product. So moving forward, SIB, we are committed to continuously innovate and align ourselves to the interests of the Kenyan public. So I want to take this opportunity to explain something that has come up a few times with some of our clients, which is some clients wondering about how we compute our returns, and some clients questioning, having some concerns around, when I withdraw funds, why is it that sometimes I can end up with a return that's different from the return that we announce to the public as a return for Mansa-X. So first is to explain that Mansa-X is a market-determined fund. This means that when you report a return of 15.59% for the year 2023, it doesn't mean that the return was a smooth appreciation in the value of the fund from January 1st to December 31st. It doesn't mean that we take a return of 15.59% divided by 365 days and that becomes what you accrue to the fund every day. No, that's not what we mean. It means that within that period, the fund, as at the beginning of the year, grew by 15.59%, including any deposits into the fund, and to give you a return of 15.59%. So it's really a factor of the growth of the fund and the market valuation of the fund. So what does this mean? You might withdraw on a day that you have a negative valuation of the fund. All right. To give you an example, if we say that we are short oil as an asset in Q3 of 2023, and that means that within that period we expect that oil prices will actually go down, and that's how we'll make a return for investors. It doesn't mean that every single day oil prices go down. Okay, there are days that oil prices actually tick higher, because that's the nature of markets, and that can happen even for a period of 2 weeks. So you can imagine for an investor who comes and withdraws their fund, say within the week when those asset classes were not as per predicted within the fund, then they might actually find a negative valuation in their statement, and their performance of their account and portfolio will actually underperform the performance of the fund. All right, and now that's really the explanation for why sometimes you have a different performance of your own portfolio versus that of the fund. In fact, you find that in Western markets, funds such as ours will have a very strict lock-in period. Most of them not less than 1 year, and some of them as much as 5 years. You know, they lock in your funds for that long, specifically to prevent these sort of issues. But within Mansa-X, we allowed our investors to have access to their funds after 6 months, mostly because we were really trying to sympathize with the Kenyan situation, where sometimes you might need liquidity before the reasonable period for how long a fund like this should run your investments. But would still encourage our investors to demonstrate more patience with how long they keep the investments with us, to prevent the underperformance of their funds, of their portfolios, against what the fund returns. Of course, the reverse is also true. You could withdraw on a day the fund has actually outperformed. Okay, and we've had clients like this as well, and they also ask us, we've had clients ask us, why did I get a higher return than what we saw you reporting out there? Was there a mistake with my account? And we tell them, no, there's no mistake. It's really that you withdrew on a much more lucrative day for the fund. So a much more patient investor will over time benefit more from a fund like ours over the long run. There's a chart we like to show, and you'll see it on the screen here. If you look at the performance of a 1 million shilling investment over the period of Mansa-X's existence, an investor who invested 1 million shillings in 2019, by the end of last year, his funds would be worth 1.939 million shillings. But if you look at that chart, it's not a straight line chart. You know, there are good quarters, there are less lucrative quarters, and within that period, the fund has still managed to almost double this investor's return, and that's our value proposition. So we'll still call for a lot more patient capital for investors, and also to be certain that there are no glitches. There are no miscalculations within the system. All this stuff is automated, and there are no miscalculations within the system. Nobody has taken your money, neither has someone added money to your account. All this is really a factor of the valuation of the fund, and the valuations of the fund are also dependent on the performances of the instruments within the fund compared to what the market prices are. So finally, I'd really like to say thank you to our investors for believing in us, for investing with us, for sticking by us, and for the feedback we also get from our investors. It continuously helps us to improve ourselves, to improve the product, which we believe over time will continue to prove that a well-diversified portfolio over time will outperform the market. I want to reiterate our commitment, as I always have, that our product is well designed to be genuinely diversified, which means it's able to deal with any unforeseen events in the future, unforeseen volatility, and still be able to have a very good trade-off between risk and return. So with this kind of portfolio, we believe that our investors over time will continue to enjoy a return that beats most other investment classes and funds out there. So just to thank you once again, wish you a very good 2023, and may this be your best year yet. And thank you from the rest of the Mansa-X team.